Welcome you to our first webinar of the year. The Institute of Economic Affairs has for 22 years now held pre-budget hearings consistently. And the pre-budget hearings, the purpose of the pre-budget hearings are two. The first one is part of a preparation of Kenya's public to the fact that the budget season is here, preparing people not just to be literate about the budget, an opportunity for budget literacy, but at the same time, an opportunity to harness professional input into the budget making process, respecting the requirements of Kenya's constitution in Chapter 12. So that's one thing, to facilitate participation, but also to harness professional input into budget making and to realize the expectation that the budget should reflect people's priorities. So the IEA divides the pre-budget hearings into two sectors, roughly. On the first day, which is what we have today, is the pre-budget hearings for the corporate sector, where corporations are firms, and of course, and firms more or less in the private sector. So the corporate presentations come in on the first day, usually on the first day, and then on the second day we have presentations from non-profit institutions representing the social sector side of society. So regarding mostly the goods that government pays for on this. So what we have today is an opportunity to hear from professionals representing a number of institutions, 4 of them today. And what they'll be doing is basically give us a rough assessment of what the last year will be, so some kind of stock taking, and then their suggestions for the ideas that the government in administration of public affairs could consider for the budgets for this year. So that's the rough expectation that we have. So our expectation is we'll have our presenters each making a presentation for 15 minutes. And then thereafter, we'll have a conversation from 11 o'clock for discussions and back and forth. And then we hope to close at about 11:30 soon after. So without further ado, I'll ask our first presenter, Job Wanjohi. Job Wanjohi works at the Kenya Association of Manufacturers.
Thank you so much, Kwame, for that kind introduction. I'm going to do a presentation on what as Kenya Association of Manufacturers, we are presenting to the National Treasury and also to the Ministry of Industry, Trade and Investment, or Ministry of Investment, Trade and Industry, for them to consider as they are developing the budget proposals, which will culminate into legislation of the Finance Bill 2023. We also have another process that we undertake, whereby we have budget proposals that are presented to the EAC headquarters, East African Community headquarters, under what is called the Common External Tariff, or rather again under the Custom Union, whereby they are considered and they are a gazette notice is issued on the 1st of July of every year, coinciding with the commencement of the Finance Act in respective countries, and especially in Kenya, the Finance Act comes into effect from 1st of July. So what I've packaged here for presentation, I'll simply say that it's just tip of the iceberg, because we have a raft of presentation, raft of budget proposals. I'm talking about 250 budget proposals that are based on the EAC Common External Tariff, and now from the tariff book, the various changes that we normally call for, from change of duty from 25% to 35% through state of application, or from 25% to 0% through what is called the duty remission scheme. But that is not included in this presentation. What we have is only for the domestic or the local or the national budget proposals. To start off, let me just make a small introduction about CAM. CAM is an advocacy body, very dynamic, vibrant, in ensuring that the membership of about 1,300 are well represented for the last 63 years, as far as the industrialization is concerned, or as far as the value addition and the policy related with the value additions are concerned, be it environmental, fiscal, trade, industrialization policy, monetary, and many others, which we look at every day to ensure that we are moving the needle or the dial as far as the industrialization is concerned. What you can notice is that, yes, there has been growth of the manufacturing sector as far as the value-added output is concerned. When you're talking of movement of the manufacturing output, these are now the reddish bar, from below 700 billion Kenya shillings to about 878, 880, close to 900 billion Kenya shillings, means that there is actually growth as far as the output of the manufacturing sector is concerned. What has been on the decline is the size of the pie as a percentage. You see the blue line. If you look from 2017 is represented by 1, and 2021 is represented by 5. You can see we have just seen a decline of the value add as a percentage of GDP from about 9.3% in 2017 to about 7.2% in 2021. But it's because other sectors are growing faster than the manufacturing sector. And that's why we normally call for diagnostic to be done now and then by the government and the private sector and all like-minded stakeholders to ensure that as you're growing the value add, the trajectory of the value add is the same trajectory as far as the GDP contribution is concerned. Because one thing we have noted is that in the manufacturing sector, there is creation of sustainable jobs. There is a drive of sustainable investments, be it local investments or foreign direct investment. When you're talking about the revenue generation to the government, if we are contributing just 77.2% to the GDP in terms of the output, but we are giving the country 1/5 of their revenues, then you can tell how much, if at all, we can grow X2 from 7.2 to 14.4. That means we can contribute 40% of the revenues that the government needs. And that now starts speaking of self-sustainability rather than depending on the debt. We're looking at how we can close the gap between 2023 to 2027, looking at various pillars on how we can move the manufacturing sector GDP contribution from 7.2% to 20%. In fact, we have pushed the bar from 15% ambition to 20% ambition by 2030. We are calling it Vision 20 by 30. And we're looking at 4 pillars. One is global competitiveness, of which we are starting at 115th position out of 152 position. Our interest is to see how we can get to 50th position and above as far as the global competitiveness is concerned, so that we can be able to penetrate these international markets and also the domestic market easily, price-wise and also quality-wise. So if we can move on the UNIDO competitiveness industrial performance index from 115th position to 50th position out of 152, that one would see us improving on our next topic, which is on the low cover ratio. That is a question of the import versus export. You can see we are quite depressed. We are 34% when you take the exports over imports, then you multiply by 100. That is about 750 billion Kenya shillings, over 1.7 trillion Kenya shillings worth of import times 100, you get that 4.6%. That is a low cover ratio as far as our exports are concerned. But if we improve on the global competitiveness, you realize that it is going to happen as far as the market penetration at the national level and also at the international level is concerned. Something else we're looking at also is industrialized agriculture. The value added, that is the value that can be added from agriculture stands at about 2.4 trillion Kenya shillings. So if we can pick what is harvested and then it is value added locally, rather than doing what is called intermediate consumption. There is a lot of value that can be realized, and this is what again can help us to push our GDP contribution from 7.2% to 20%. So there's a lot of value that lies in agriculture, if at all it is industrialized. And then when you look at the MSME, like now Kenya Association of Manufacturers, 60% of the players within Kenya Association of Manufacturers are SMEs, 60%. And then you can see 24% in the economy are MSMEs. No, the 24% that's the level of GDP contribution by the MSMEs. When you're talking about the level of businesses, 90% of the business in the country are within this band of the MSMEs. And then the job creation starts at around 93%. So you can see the importance of these micro, small, and medium enterprises and the role they're playing in the economy. And these now make the four pillars that Kenya Association of Manufacturers is running with. Global competitiveness, you can see on our focus tower, is what now we are saying is the foundation. If you look at the building theory, if you don't make a good foundation of the building, you cannot get to the rooftop without that building collapsing. So we are saying that our foundation, which needs to be very firm, is a global competitiveness. So that now once we are competitive, we are able to grow our economy through exports, we are able to industrialize, and again, we are able to drive our MSMEs. Quickly jumping into the national budget proposals, and I say that this is just tip of the iceberg. We have multiple high number of proposals that we are making to the National Treasury and also to the Ministry of Industry. One is the miscellaneous fees and charges. What we have noted is that various national ministries and agencies normally come up with arbitrary, multiple, and duplicated fees and charges without necessarily passing through the budget making process, like now the public hearing that we have today, or the public presentation that we have today. You find that they're sneaked in at the parliamentary level, or even when the document has been submitted at the parliamentary level, when it's going for accent by the president, you'll find there are some things that have been introduced. So what now we are calling for, and this is our proposal, is that any fees, levies, and charges that have been, all of them need to be submitted through the budget making process. That is, we submit to the National Treasury. National Treasury hears from the Ministry, Department, and agencies about the fees and charges and that they want to levy, and that at that point then it goes to legislation. Without doing that, then such should be treated as null and void. What we are seeing as outcome out of this is that we can have predictable business environment rather than having arbitrary introduction of fees and charges. Have well-coordinated structures at the national level. We are likely to see the reduction as far as the cost of doing business is concerned. And then we have visibility of all taxes imposed by the national government agencies, rather than the way they sit in the respective ministry, department, and agencies. We have visibility through our legislation. The second one is on Sugar Bill 2022, looking at how these can be amended through the budget making process. There is a proposal to introduce a sugar development levy of 10%, and our proposal is that we exclude the industrial sugar from the 10%, so that we can allow the development of the industrial sugar production in the country, such that what will be charged the sugar development levy is the brown sugar or the table sugar that is being imported, but not necessarily hurting an input that is coming to be value added locally. And then some of these industrial sugar, when it is value added locally, you find the products are penetrating in the EAC market, the COMESA market, and many other markets, even in Europe. Credit for input tax against output tax. We have some zero-rated supplies that were made before 2019. And the formula that was being used then before 2019 was changed. And then the manufacturers were able to access their refunds calculated between input tax and output tax. But anything that had been charged before 2019, manufacturers have not been able to claim. So what we are saying is, if they are able to claim from 2019 coming onward, why can't we have a provision being introduced that is going to allow the manufacturers to claim for about 3 to 5 years back from 2019, now going back, taxes that were deducted but need to be refunded because the input tax had been when you calculate the input tax and the output tax, there's refund that need to be done. So what this is going to do is going to enhance the cash flow of the manufacturers. Instead of having overdrafts, of having loans, it's just a question of refunds coming through from the National Treasury, through the KRA, through provision within the law. The other one is on the withholding VAT. I believe that we are all familiar with this. Our call is that the withholding VAT, because we have agents that have been nominated and they withhold 2%. And the effect on this is you find that there is buildup of credit, and then you find there is deferred burden that is coming from the part of the government. What we're calling for, so that also we can enhance the liquidity, reduce on the buildup of credit and the deferred burden, is the reduction of the withholding VAT from 2 to 1%. And this, again, can be done through the Finance Bill 2023. And then the other thing on it is that we are asking for 1-year transition, and then this mechanism is removed, because like now we have a tax invoice management system that has been introduced, of which may be a bit duplicated with this withholding VAT. VAT on plants and machineries of Chapter 84 and 85. You find that these plant and machineries of Chapter 84 and 85 of the tariff book, they are charged the VAT. Our ask is that we have this VAT removed. If at all is moving it to zero-rated status, not even exempt status. This would help the manufacturers as far as refunds out of these industrial machineries are concerned. This had been introduced earlier through the Tax Law Amendment Act 2020, and if it can be reversed, you can see we are going to see the cost of operation going down. We're likely to have new investors coming to the country, and also the expansion of the capacity for the existing players, already existing players. The other one is on export services. You find that the export services today are taxable at 16%. You can imagine that an engineer who is in a multinational in the country and is servicing another branch that is in Cote d'Ivoire or is it's in Angola, they have to pay for the export services 16%. And this now makes us less competitive in the region. And our call is that how can we have this not being exempted, but to have it as VAT zero rated, because at an exempt there is no gain as far as the taxpayer is concerned. But at a zero rated, you find that the manufacturer is able to claim the 16% as a refund. So the other one is VAT refunds. We have been having a big challenge as far as the VAT refunds are concerned. The allocation given by the National Treasury per month, you find they are way low below what is required. If at all we require like refunds of 4 billion shillings per month, they are only allocating 1 billion or 1.5 billion per month, of which that is not adequate. And that's why we have accumulation of the tax refunds. So what we're calling for is that how can we have 1% of the taxes that are being paid monthly being put in a special purpose vehicle, and that's what now we're calling the tax refund fund, that is going to facilitate the payment of the payment of the refunds promptly. And these are the refunds that are collected from TPA Procedures Act, Income Tax, Excess Duty Act, Value Added Act, Miscellaneous Fees and Levies Act. And also, as for the purposes of the excess taxes that have been paid or erroneously paid, also this can be taken care of more promptly. So the other thing also we are looking into this is to ensure that we have prompt payment, that is, there's no undue delay. And then once we are closing the 9th month of the fiscal year, we have a presentation to the Auditor General, the financial statement by the National Treasury on the status of the tax refund fund. The National Treasury need to come up with the modus operandi or the modes of administration of the fund, so that you don't fall in the trap that you don't have regulations that have been put in place. If not that, then we can have a tax refund bill 2019 or 2022 being presented before the Parliament, so that it can take care of such fund. So this is going to enhance the cash flow for manufacturers and also make manufacturers avoid the costly loans and overdraft, that hence reducing the cost of doing business. Investments deduction allowance is something else that is hurting manufacturers. They're unable to move from the towns like now Nairobi, Mombasa, Kisumu to other counties for industrialization. So we are calling for reversion from the current rate of 50% first year investment allowance deduction, investment deduction allowance, and then 25 the subsequent years. And we revert to 100% investment deduction allowance for Nairobi, Mombasa, and Kisumu, and 150% for outside Nairobi, Mombasa, and Kisumu. This is going to enhance industrialization at the county level and also increase investment. On the excess duty on exported goods, no need to pay for the excess duty for the inputs, the raw materials, and the packaging materials. And then we cannot be able to claim that excess back, especially for subsequent exported goods on inputs whose excise duty was paid. So we are asking for exemption of excess duty on export goods whose input excess duty was paid for, so that we can promote investments in exports, reduce the cost of production for exports, and increase the foreign exchange. Again, on excess duty on cosmetic, there's an excess duty of 15% that is being charged currently on body lotion, petroleum jelly, shampoos, personal deodorants, and perspirants and hair food. Sorry. Our call is to reduce this to 0% so that we can promote the local cottage industry, ensure that utilizing maximally the local capacity as far as cosmetic manufacturing is concerned, and also improve on the competitiveness. Inflation adjustment on specific rate for excess duty. This is adjusted annually. Our call is that this is revised, and then the adjustment is done after 3 years, so that we have predictability as far as the tax environment is concerned, and also allow us a little bit to recover from the effects of the COVID-19. And also the government can realize sustainable revenues because the rate is predictable and the rate is known for a period of 3 years. That's the end of my presentation, and over to you, Kwame.
Basically, what you mentioned is, or rather, it gives me two things: that the challenge for expanding investment in manufacturing, which is important to raise, of course, its value-added output from about 8% now to raise it to 20% as you envisage, would require significant reworking of Kenya's tax policy. You mentioned something about excess taxes, the arbitrariness of tax raising. Every year, you talked about the intractable problem of tax refund mechanism. So it's very, very clear that a specific policy to deal with that is necessary. Other difficulties around the common external tariff. And obviously, I think what it tells us is, I think in this budget season, such as every other, we actually need to ask or speak to government about making taxation coherent, raising investments, which we cannot do without. And obviously, I think providing incentives for value addition in agriculture, which you mentioned, some very interesting figures, which would actually be substantially not just generate value incomes, but at the same time the potential for significant revenues for the public sector. So thanks a lot, Job. I'll go to our next presentation. We'll have the question and answer session after this. And obviously with Job's permission, for those who are watching, for our audience, we'll have the presentation circulated. They say that it's a much bigger one. So obviously we'll provide you with the link so that you can interact with it more closely. So thanks, Job. Our next presentation is by Dr. Timothy Njagi from the Tegemeo Institute of Agricultural and Policy Development.
Thank you so much, Kwame. Yeah, so we posed this question because Kenya Kwanza had made a lot of promises, and especially for agriculture. And I think we've also seen that in the few months after the administration came into place, they have been trying to kind of follow through, although some of the proposals you'll see that we are critiquing some of the things that they're trying to do. So just to contextualize, again, for you to understand where you're going with this question. So within the sector, we do have the agriculture sector transformation and growth strategy, which is supposed to guide the long-term investments for this sector. So we have three key output, or I would say what outcome. These are goal level indicators. So the first one is increasing smallholder productivity and incomes. The second one is to increase value addition and agro processing, and the last one is to build household food resilience. I think what Kenya Kwanza did, especially if you look at their manifesto, we try to look. Agriculture is identified as one of the key pillars, and of course, like for the first one, which is to raise agricultural productivity and income, they basically have broken that out into two. So one is that they are prioritizing raising agricultural productivity, and to ensure that producers and addressing the issue about income for producers, what they have proposed to do is to reduce the cost of inputs and of course enhance access. One of the other things that we've seen that has been prioritized is to reduce reliance on importation as a measure or as a strategy of attaining food security, and also enhancing public investments in agriculture. So the key thing or the key theme there is that, if we reduce reliance on food imports, we're able to enhance our foreign exchange by addressing, incomes and productivity. Then you're able to raise jobs, improve incomes, and also use the sector as a key strategy for poverty alleviation, and of course with the linkages to industrialization. Again, this is consistent with the goals within the SDGs. Then we'll be able to promote, especially agro-based processing, and kind of adopt a path of agricultural-led industrialization, similar to what Ethiopia has done. So, having that in mind, I think what I wanted to clearly make sure that you're all together and what that means, because I think when you look at the policy proposals, is that you realize that we have missing gaps. So what does that transformation mean? So where we are right now is on the farthest left side, where you see that if you look at our rural population, which is about 70%, most of them are young. I think it's about close to 70% who are below 30 years. And about 70% relying on farm for income and livelihoods, and we have a 30% that is doing non-farm. The challenge, of course, is that for the people doing farm, which are the majority of the guys, most of the farms are what would categorize as struggling farm. So yes, you engage in agriculture, but you're not making meaningful income, and you're trying all the time to see how you can diversify your income sources to be able to meet your needs. And then a small proportion is what we consider to be successful farm. And also for the non-farm, majority of the non-farm is also what we consider struggling, because most of these are businesses based on low-level skills, and what would consider to be successful non-farm is about 10%. So if you were to transform the sector the way it is actually envisioned in the SDGs, then you want to move people out of agriculture, so that the few who are in the struggling farm, not everybody can be converted into a successful farm. So it is the realization that from that aspect, you will move some people to the non-farm sector, where you want to target them to be the successful non-farm, and then those who are already doing the or struggling within the non-farm, you try to have measures that convert them into successful non-farm. So I focus more on the lower part, which is how do you get now the few people, and how do you get to this 30% that is successful farm? So of course, and this is now again linking to what has been proposed in the budget, and trying to see whether there's a handshake between the policy objective and actually what is being implemented. And you realize that for us to attain this successful non-farm, we need investments in R&D, we need investments in extension, because that's how we get the farmers to be able to utilize the R&D. We need reforms in land access and tenure. We need also reforms in agricultural marketing and how we can enhance trade. We need to think of how we can provide farmers with credit and access to capital. And then we need also to provide public goods, especially if you think about irrigation, transport, electricity and communications. So for purposes of today's presentation, I don't focus on what we need to do to attain successful non-farm, but of course you'd think of trade policies, investments in infrastructure such as health, capital, human capital investments to ensure that people have skills that they can actually use to in the non-farm sector. We also need some investments in public goods as well, and we could think of even things like housing and physical planning, especially because that is one of the bases that will help us enhance utilization of land. So if we are to achieve that, and then does our budget set us on this path? Because this is the path that we are saying that we want to take. So then the next thing we do is to look at now the proposals that we have made, and basically looking again where we are coming from into the performance within 2022. And of course, 2022 was a year where all the shocks basically converged. So from the effects of the pandemic, we had a drought going on, and then we had the Russian invasion, which has the Russian war had a unique impact, both on agricultural inputs as well as global food prices. So in 2022, food inflation was a key contributor to the overall inflation. And of course, the cost of living as it is right now is something that continues to be in discussion, especially for the public policy. We have an ongoing drought that affected quite a number of counties. Most of the people who have been adversely affected, of course, are the ASAL counties. And then the supply chain shocks, from the pandemic and also the Russian war, exacerbated, the input prices and constrained access to input, mainly because people could not afford them, or even when the government tried to intervene, that intervention came quite late after the season had already started. So the sector right now is, of course, has been flagged as a risk, especially going into 2023 in terms of meeting the economic growth targets. And the prediction is that it's a bit pessimistic, and of course we know that when you think of food security this year, again we are going to be affected because of what is happening within the global food markets, and of course one of the challenges, of course, we face has been the widening resource gaps. So this is what I mean by, if you look at the trend, you realize when you look at the global food markets, we are yet to go back to the pre-pandemic levels. In fact, because of the Russian war, that has kind of complicated things, and we do expect that whatever is happening in the global market will have significant effect on us, mainly because, again, we are a net importing country when it comes to food. So yes, we can try to reduce reliance on imports, but again, we do expect that whatever happens outside there will provide incentives that, especially for local producers, that generally this will be something that we'll have to continue paying attention to. So now coming to the budget proposals, we basically just highlight some of the key flagships. And again, you realize that the reason we are flagging this is because there's a bit of inconsistency, especially if you think about the transformation agenda and the pathway in which I've just presented a few minutes ago. So, of course, we know that the sector is highly devolved. And of course, at the national level, one of the things that is still missing and that we would have loved to see in that proposal is the element of capacity building. So, for example, we know that right now in this budget, a lot of funds have been provided for the subsidy programs, but as we've shown in the past, providing subsidy without necessarily ensuring that farmers have knowledge does not change anything. And we already have 10 years of our own experience, but we seem not to want to learn from that. The other thing that we see, of course, the government is trying to support value addition and marketing. And building on from what Job has said, is that we see that there are some constraints that will go in there, partly because some of this, especially when you think about value addition, I mean, we do expect that this should be private sector led. But once the national government starts that, and then we've also seen county governments also going into value addition, then you really wonder what the role of the private sector would be. And especially if you consider economic literature, which clearly shows that most of these public sector business enterprises will eventually fail. And we should be thinking of how do we incentivize the private sector to be making these kind of investments. We also have sector reforms, and I think this I'll touch on, I'd flag again something that Job mentioned, that if you think of the reforms, right now we are reverting back to the commodity boards. So we've already fully reverted T-board. Now T-board is up and running. Coffee, sugar following suit, and of course for sustainability of the boards, what they're doing now is introduction of levies. And I think Job had already indicated like the sugar levy would have an adverse effect, and that's likely to have. But this is again something that has to be taken in balance. In terms of sector allocation, although we've seen that the current proposal allocates significantly more resources, and this is you can actually look at the trend that it has actually been coming down, especially based on the Malabo targets of 10%. So the key challenge is that, of course, how you also spend that money matters. But what we've seen so far in the current proposal is a significant improvement from last year, and we think that if more money is also allocated to the counties, then we can expect that there'll be an increase in public sector. But again, I will not be very. I'm not very optimistic, because what we've also seen is that generally when you look at the budget proposal and you compare that with expenditure, then you realize that there's a huge deviation, especially when it comes to expenditures. So this is just again to flag the resource gap, and of course I'm showing the resource gap based on the different departments. But the key take home here is that although overall we do have almost half, it's about 44% deviation on average, you realize that for some of the entities the deviation is quite significant. So if you think of National Lands Commission, for example, they're only getting 25%. 26% actually of the budget that they're requesting, and they have a deviation of 74. Crops are getting slightly slightly below half of what they're requesting. So the only ministry that seems to be close to what they were requiring would be the State Department of Livestock. And I think the prioritization for livestock is because of the ongoing drought. But then for these other departments, if you think about service delivery, again, you start getting worried. And that means that, again, going back to what they're prioritizing becomes important. So a key critique, I've focused on just two major bullets, is that one, when we think about the reforms, the government, especially in this budget, we are losing a key opportunity. One is that because in 2014, we consolidated the regulatory institutions to form AFA. And then last year, we decided to walk back that. So right now, we have some kind of instability, especially if you think about regulatory processes. And it doesn't seem that they have prioritized, how to quickly, revert to those boards, and how those boards can be up and running, and how they can be sustainable. The other thing is that, of course, past government reports, including task forces, have always recommended the privatization of commercial sagas. And a good example would be the sugar processing companies. So even in current reforms, we think that again, that as the government is trying to limit or to reduce the number of semi-autonomous government agencies within the sector, one of the key opportunities is to privatize the commercial sagas. So the ones that are dealing with processing, value addition. So we have the sugars, we have the pyrethrum processing companies. All those should actually be privatized so that it can allow for investments to come in. And of course, these investments would be private sector driven, and the government can now see how to provide, a conducive environment that they can thrive in terms of incentives. We also see some conflicting policy targets. So, for example, there's a huge target on issuance of title deed, which we know that has been a key driver, especially for land fragmentation, because a target within the Ministry of Lands is how many land titles they are issuing. And land fragmentation continues to be a key challenge for the sector, because most of our lands are becoming unsustainable, so small that you cannot economically intensify in those plots. So how do we then balance that and try to think of how do we even provide incentives for people to consolidate land, because what is key is not actually just the title, is the tenure and the security of that tenure. We are also concerned that, of course, the government continues to provide crop and livestock insurance, and we are not seeing this being picked up by private sector, and partly is because of lack of public goods. The most important one is data. Data on trends, on production, on weather, whether it's you're talking about index-based weather insurance, and because of that lack, then this remains something that the government continues to do, although it's something that can be effectively, pushed onto the private sector to continue to provide this particular service. For taxation, I think Job has clearly explained the effect that this has, especially on agro-processing and industrialization. And we've seen, for example, the lack of predictability, especially when it comes to excess duty, the annual inflation adjustments that are being done, that is resulting in cutbacks in taking up raw materials from the sector. And for some commodities, it's clearly becoming a disincentive, because either farmers are switching to something else because they think that those markets are not stable. So the government should also should carefully consider the effects, especially of taxation, not just on, in this case, industrialization, but also even on agriculture, especially because whatever happens there trickles down to the farm. Then, of course, we are a bit disappointed that the government is reverting to the general fertilizer subsidy, especially because they have a better program, which is the e-voucher program, that is much more better, much in terms of efficiency and effectiveness. And we have 10 years, and we have data that actually shows that, the subsidy, was skewed in terms of distribution. It failed to raise productivity of any series. We spent a lot of money, and that we did not get anything out of. So our recommendation is that, what the government should have actually focused on would have been to expand the e-voucher program. The e-voucher program bundles inputs so that you're not just giving fertilizer, but you're also giving seed, you're also giving agrochemicals. So that then the county government, instead of now trying to bridge some of these gaps, they could think of how then to strengthen the extension services, so that we can actually see some return from some of these investments. Then some key assumptions, of course, is that we will expect to see some additional resources coming from the county governments to boost public investments within the sector. But if you look at, again, past trends, we shouldn't be overly optimistic that is what will happen, because we know that from whatever the county governments have been getting, I think on average they've been doing about 6%. And again, this is on average, so it's actually skewed across different counties. So if there is no coordination so that the county governments can also prioritize agriculture, then we know that will not happen. But we think that the best opportunity lies with enhancing private sector investments in the sector, and we should actually focus public sector investments to crowd in private sector investments. So that means that we should be prioritizing R&D. For example, we know that right now we've lifted the ban on biotechnology, but we're not seeing any investments both in research institutions and also within the Biosafety Authority to make sure that we have a better regulatory framework, and we can also build our capacity to utilize biotechnology from our own researchers and our research institutions. We really must emphasize the importance of investing in knowledge and information systems, because that is the way we get that information to farmers, and that is how we get farmers to adapt modern technologies. Lastly, we also need, agriculture data has been something that I think continues to be a key challenge. Again, we are not, although we are seeing, for example, the government says that they're going to use chiefs, and that budget is not in agriculture for registration of farmers. I think it has been moved to the State Department of Interior. We think that prioritizing an agricultural census would have been really key, especially to know the type of farmer, what they're growing, and that can also inform what kind of support they can be given. Given that now we've walked back the regulatory reforms that had been done to consolidate the regulatory bodies, we really wish that this year we can quickly revert or reset to whatever bodies were there before. So whether it's sugar, go back to sugar board, coffee goes back to coffee board, and then we can have a predictable regulatory environment. Because in terms of regulatory environment, of course, one thing that is clearly uncertain is how they implement the regulatory, or how they influence the regulatory aspects in relation to county governments, so that, like we've had with the issue about taxation and cess, we don't go back there. And for the objectives, especially that has been mentioned in terms of transformation, we really must strengthen the link that the administration has really prioritized in terms of value addition and agro-processing, and try to make sure that the policies or even the investments that you're bringing in are kind of linked without necessarily looking disjointed, as is the case for the moment. So I think I'll pause there.
Thank you very much, team. One of the things I like to, when I listen to, the way the IEA plan this is actually manufacturing is accepted as a private sector enterprise. But the way people speak about agriculture often sometimes suggests that people think that agriculture is government's, is a public sector good. And so I'm really glad to hear team emphasize, quite apart from the fact that the number of farms and the number of people involved in farming activity tells you that it's very deeply private enterprise, and government needs to actually think about how to drive investments in there, as opposed to trying to be itself a farmer. So Team Adabla, wanted to hear some of your comments around the experiment in Galana Kulalu, which we'll come to later, but as you and I can tell, we'll be back in another budget season saying, we told you this, but maybe not. Maybe I'm just a bitter old man who hates government investments. But we'll speak about that later. I think you also said something that we at the IEA have been saying quite a bit, that I think government needs to make a choice, and the choice that they need to make is clear. The subsidy program is defensible for agriculture for the reasons that we say, whether for improving farmers' incomes, which is legitimate, or in improving food security, which is a bit of a stretch because food security is in Kenya is described as maize. But I think you're still right that we need to make the most efficient choice in subsidies to farms and agriculture, because what we have right now results in, it's inequitable, but also at the same time it's making government both buyer, transporter, warehousing, and all that of subsidies, which can be done very efficiently through another project the government has tested and which appears in the transformation strategy, which is e-vouchers, which works much, much better for productivity. So I think this back and forth and actually distributing one this way, I think a cost effectiveness around that is one thing you're asking us to do. And I think I like the fact that subsidies, as you state, subsidies, even when they're defensible, without the knowledge actually changes very little. And I like your call as well for privatization. I think this new administration came up, they were a bit jittery in their plan. They did not mention privatization. I don't know whether it was tactical. They mentioned privatization very early in the days, and since then it's gone a little quiet. As you can see, I think there's an expansion of government investments, even in areas where that would be direct competition with private sector, which is a bit unfair. So I like your emphasis on enhancing private sector investment. I think the linkage, backward and forward linkages, but especially to manufacturing. And you mentioned something that we should speak about just a little later, separately, which is what you started with, is about the off-farm and in-farm incomes and successful farms. I think one of the things you're telling us is that farming is private sector activity, and that is a possibility, just like other businesses, of unviability or poor management, which makes some farms, accommodating the view that some people might have to exit farming is a conversation that is politically difficult, but one that you're probably asking us to have on a different day. So perhaps we can discuss that later. So thanks a lot, team. We'll have an opportunity for question and answer. Let me go now to Elias Wahisi for the Institute of Certified Public Accountants of Kenya, and he'll be talking about what the corporate focus for the fiscal budget, for 2023 and 2020, financial year 2023 and 2024 should be. So, Elias, please welcome.
Thank you so much, Kwame. Thank you, IEA, for this opportunity and even for this forum. And also thank you to the speakers that have just spoken, Dr. Timothy and Job. Let me project. My presentation is focusing on the corporate sector, and first, just to appreciate the tax proposals that have been given by Job. And in my presentation, first we look at the corporate sector in terms of the environment of the corporate sector and its contribution to economic growth. And then secondly, we'll be focusing on what are the key drivers for this sector in terms of the budget and what we need to do for the fiscal year 2023-2024 for us to spur this sector. And then lastly, we just focus on other proposals that can underpin this budget. So to start off, for those who are interacting with us for the first time, ISPAC is the Regulatory Board of Accountants, and we regulate over 32,000 members now, both in private and public sector. Again, I won't belabor this because this you've seen in quite a number of documents about the environment we're operating in, the issues around inflation, the issues around climate change, issues around limited access to foreign finance, where you have major economies then trying to focus on their domestic economies first before going out. And we still have uncertainty on dissipation of COVID. And we've been seeing a lot of information in international media on the recent upsurge in China, but this is just the global environment. So for the corporate sector, first, the discussion we started with is on the contribution of this sector. And one of the contributions of corporates is to the major aspect of tax revenue. And we're looking at data from the Kenya Revenue Authority, the annual performance for the financial year 2021-2022. And you can see that corporation taxes contributed 242 billion for the year 2021-2022. And still looking at that, you can link the same to pay as you earn, which contributed around 461 billion. And this you can actually compare with domestic taxes collected by that period, which was around 1.8 trillion. And then you'll be able to see that there's a big contribution of the corporation taxes in terms of contribution to revenue. This other table on this other side is looking at, this is basically from the Economic Survey 2022. Again, just to buttress the point of contribution of corporation taxes. And you can see the growth income tax from individuals, this PAYE, 363, up to 393, 399, 363, 435. And then corporations, we have 277, and that's the focus of our discussion, 291, 307, 330, 398. And we can partly say they also contribute bit or part of the value added taxes, which you have seen in there. And when you do as a percentage of the total tax revenue, then corporation taxes and corporates have a bigger say in terms of tax revenue for the country. And that's why the focus of our presentation this morning is on cooperation, on corporates and the contribution of the corporate sector. Secondly, just moving to the next slide. It can't. Some bit of okay. The second perspective is on employment creation. Again, looking at corporates. Analysis of the 7 KRA corporate plan. That was 2017-2018. I couldn't get the latest statistics, but that should be above that 78,000 corporates that were compliant. Compliant means they are paying taxes and they are contributing to the national cake. And here we're focusing more on employment, and you can see that if we assume there are more than 100,000 corporates, then in terms of employment creation for Kenyans and for the youth and majority of Kenyans, then they play a critical role. Of course, the Economic Survey 2022 gives us a figure of 1.9 million. That's 1.9 thousand, the way it's indicated here. And that shows actually why we need to focus on this sector. So 2017, 1.9, 2.0, 2.0. It's a bit of a decline, but again, that's the contribution. The other benefits that again have us focus on corporate sector is the aspect of corporate social responsibility, and we are looking at sustainability. Currently, and globally, the whole discussion around sustainability, environmental sustainability, contribution to livelihoods. And we're seeing corporates, the Safaricom, so many other corporates doing a lot in terms of changing livelihoods for our people. And then lastly, the whole contribution around PPPs and public-private partnerships is very, very crucial. So for this year, and if you are looking at the budget, what are the growth drivers that we need to focus on? One, and national tax policy. And we've had this discussion for quite some time with National Treasury and even with Parliament. We are lucky that last year there was a draft that was subjected to public participation. And even this year during the launch of the pre-budget hearings by the CS, there was a mention of expediting this process. We still reinforce the fact that it's important for us to finish this process, so that one, we're able to have a predictable tax environment. So each day you don't wake up and you have this. Secondly, we've been talking about expansion of the tax base, and I'll talk to it much later when focusing on the informal sector. That for us to expand the tax base, then we need to have some form of anchor, and the anchor for us is that national tax policy. The other importance is, yes, we have a new constitution, we have new existing legislation, and we need to harmonize so that whatever we do in the realm of taxation doesn't offend the constitution. And we've seen the recent court cases around some of the tax proposals. They could be related to actually how then, what are the rights of the taxpayers? And that's why you need that national tax policy. Of course, and this is very important for the corporate sector, certainty in the framework on tax incentives, that today you have an incentive for agriculture sector, tomorrow that incentive is removed, you have a new incentive for manufacturing or for tourism. So the tax policy then will help us really have that. IEA then takes up the aspect of national tax policy. The other huge thing for corporates and the corporate sector is for them to continue contributing, as earlier shared in the earlier statistics. we need to deal with the larger problem of pending bills. And we deal with it for once and just finish it, or try to reduce the pending bills. And we try to give some statistics. These are from the control of budget reports. And you can then, yes, that's a national government level. As of 30th September 2020, and we'll just try to outline some of the effects of pending bills if not dealt with. One is the effect on investment, that investor confidence is eroded. Entities risk losing reliable suppliers because why should I supply when I'm not sure whether I'll be paid for the next 3 years? And that is something that needs to be looked at. It has an effect on other metrics of the economy, like private sector credit, that then is stifled. Banks then cut lending to government suppliers. They are not certain that you'll be able to pay or to repay back, or those higher defaults. And then the other issues around cash flow problems for businesses, because they're unable to pay their workers, to pay rent, and eventually even the MSMEs that we're discussing here and other corporates, they end up then closing shop because of such kind of issues. So we have to deal with this. At the Institute, we had proposed one is to change to accrual accounting as one of the areas of being able to recognize this type of expenditure, so that subsequently, even when you have new governments, they're able just to come and pay. Or secondly, we had also lend our support to a prompt payment legislation to force, using that term, entities then to pay their suppliers. This is a very big issue that we have to focus on, and we're hoping that government will allocate enough resources and give certain incentives, carrot and stick, to ensure that this is sorted. For 2023, looking at this year and some of the issues that corporates will deal with. One is taxation of gains from financial derivatives at 15%. This now became, the regulations will be ready this year by January. So we looking at what these regulations will provide and how they will be the due date and how they'll be remitted. In most cases, since they are targeting non-residents, such kind of tax proposals targeting non-residents, most cases, those persons tend to resist. In a big way. You remember when with the advent of COVID, a lot of corporates and entities moved to digitalization and adoption of e-commerce. Now with these transactions, if you look at those people who do bulk transfers and bulk transactions, or they pay wages through those transactions, then it becomes a real burden. VAT on 16%, VAT of 16% on online services. This will impact on ebooks and even streaming services. These ones, those are things that we have to look at. And of course, one of the, we can say, light at the end of the tunnel is this voluntary tax disclosure program that then corporates need to take advantage of, so that they are able to declare their liabilities within that specified period. Allow me at this point to just make other reflections on other government policies, and one of them is this. the proposed suspension of non-priority expenditures, what we are calling austerity measures, and the government is proposing to rationalize the budget to reduce the fiscal deficit. And in this, we are seeing, if you read documents coming from National Treasury, you're seeing the proposal to suspend, and I like the use of the term suspend instead of scale down. Suspend expenditures such as foreign travel, domestic travel, communication, printing, training, hospitality, fuel, and all that have been mentioned. Yes, it's a good idea. Just trying to look at trying to reduce the deficit, but then we have to be cognizant of the auxiliary sectors that are dependent on these services. We have to look at local tourism. We call it conferencing. We have to look at the private sector dependent on even some of these even maintenance, and look at the unemployment that it will cause if it's suspended. So the best thing then is not to talk about suspension, is to talk about scaling down. And this is something that is open for debate. I'm happy with the huge number of us who joined this call, that this is a reflection that we can make to see how do we do it without hurting some of the sectors of the economy. The other reflection, and I'm happy it was started by Timothy, is the aspect of subsidy. And we've had all this debate around, it's a big debate around subsidizing production versus consumption debate. Of course, my slide tried to give a bit of what production subsidy is and consumption subsidy, and this I may not go in. But in terms of reflection, we need to have a national conversation on how best and how sustainable can we do these subsidies. So if we decide to say we are subsidizing production, how sustainable in the long run? Will it eventually lead to spur economic growth without hurting certain segments of the society? Or do we then talk about consumption and debate and say maybe removal of consumption had an effect on certain sectors in the short run? So we have to make some conversations around the subsidy discussion and make it a national conversation, so that it's not just the policymakers and people sit and say, okay, this is best for us. I was just trying to look at some of the advantages and disadvantages of some of these subsidies. Yes, they can control inflation. They can offer great supply of goods, but sometimes it's difficult in measuring success in some of these things, and they can cause even shortages. And we saw shortages sometimes back when discussing these subsidies. We took an example of the case for fuel here, and why maybe we need to continue discussing subsidies. So I'm sharing this slide not to push for an argument, but then to have us go back to that conversation of, do we need consumption subsidy, production subsidy, sustainability, those kind of conversations. And when you look at this was from April, when you look at this this table on the left of my presentation, you can see the composition. The first table, so I did name them. Landing costs around 44% in terms of petrol, 46% diesel, 49% kerosene. Taxes, a huge chunk, 58% petrol, 43%, sorry, 45%, 39% and 36%. Then we have storage and distribution, and then you have demurrage costs. So before the removal of the subsidy, we used to retail super petrol at 134, and then currently around 179 now with the removal. Then 115 for diesel, now 165, 147. And of course, there's that figure of the subsidy. On the other side, the last table, we're just trying to share the contribution of taxes to fuel taxes. So these are the fuel taxes to tax revenue, and this was shared by KRA. So you can see, if you argue that then the proposals that we're giving. Then lastly, didn't get much data, but then there is a debate around the cost of electricity, and we're looking at the State of the Nation address by the former president, who was saying that the government had embarked on a pathway for reduction of cost of electricity. This is something that we can then still take in this discussion, in the current discussion around the budget process, because the increase see economic equity start by supporting your local business. One small business in one small neighborhood is the backbone of sustainable economic progress. Thank you.
We thank you on behalf of, on behalf of the IEA, we thank you for making this presentation on behalf of the ISPAC and concentrating specifically on, especially the fact that you asserted the interest in concluding the national taxation policy, because the taxation policy, I think, should provide coherence for what should be. We argue at the Institute of Economic Affairs that actually taxation policy is determined by who changes the tax rules. And the tax rules are changed substantially through Parliament according to Article 2000, Chapter 12 of the Constitution, Article 209 to 212. Read together, do is discipline taxation, because taxation in Kenya is so difficult that I think nearly all the whistle start, whistle stop policy. So one time we have excise duty on one thing and then the excise duty on the other. Excise duty itself now is a general tax for anything that government wishes to raise money on and stuff like that. So we are thankful for that. I think you spoke also about the austerity measures. I think this new government will see whether the supplementary budget reflects this. It was supposed to have come like 4 months ago. 2.5 months ago. We expect it at the end of this month, and let's hope to see that, but that there was some kind of disciplining expenditure and austerity is needed is important. You mentioned a critical thing. As a citizen of Kenya, one of the things that I think we've spent on in the last 15 years, having been here, is that Kenya, at both national government and lately in the county government levels, we've spent more money studying pending bills than paying pending bills. And that might tell you that there's a very big issue quite there. So that the certified public accountants of Kenya are speaking about it is necessary, because I think to audit all those pending bills is an essential thing. And perhaps government might actually just have to put aside some resources for the Office of the Auditor General to actually audit pending bills separately for each of the arms of government. Because I heard yesterday, I think the county government in Nairobi, in my recollection, in the last, 6 or 2 administrations has audited the pending bills thrice. So this will be the 3rd time. And not that audits are a bad thing, but having committees again and again is itself become a separate business. So government is auditing its pending bills instead of paying its pending bills. And I think there's the question of tax refunds and all these other things. So obviously, I think something out there. You mentioned something that's also important, which is subsidy design. So even if we accept that subsidies must be given, whether for popular reasons, there might also be welfare reasons for giving subsidies. The way subsidies are designed, and actually a subsidy policy could be part of taxation, because when you do subsidies, you're actually interfering with public revenues and how public revenues are spent, and creating new liabilities for government. So if you look at the petroleum one, my favorite, because it's a perfect demonstration about how a subsidies once started can actually completely go out of hand. And deciding on what it is. I want to state here that we at the Institute of Economic Affairs get very interesting insights, because when you hear people speak about production subsidies and consumption subsidies, and a few people in the new administration have taken this as very clever economics. To be honest, they're saying nothing. Whether you subsidize them on the production side or on the consumption side, you're doing the same thing, reducing one person's costs and actually raising revenues and redistributing income. So the idea that a consumption subsidy is more efficient than that a production subsidy is more efficient than a consumption subsidy is actually for the overall welfare of the market. My microeconomics, and I've confirmed this, tells me it doesn't matter. So to think that you're saying a subsidy on the consumption side is a clever thing, I think is something that maybe we should push back on. And I'm glad that you've called for that, because we need to push out. It's bad economics reasoning. It's just not true. And then on the current question of Kenya's electricity costs, I think that's one thing to consider as well. Let me now call on Dr. Emmanuel Manyasa, who's our agenda. Education is one of the areas in which government spends a lot of money. And just like other sectors, education has both the private sector and the public sector components. And big education moves are being made which have fiscal consequences. So I invite Dr. Manyasa Osa agenda to give us a presentation. He's speaking about what should the budget priorities be for seamless transition into this big question of CBC. So welcome.
Thank you, Kwame, and thank you for this invitation, IEA, and for everyone who is present. So very briefly, an introduction of what has been going on in our education sector. You will see that for a long time, and actually since our inception as a nation, we have grappled with the issues of access to education, quality of education, equity in education, and relevance of this education. And because of these challenges, the government has made a lot of interventions along the way trying to redress these problems. In 2003, we implemented free primary education. In 2008, we implemented free day secondary education. In 2017, we implemented the 100% primary to secondary transition, and also around the same time started to implement the change of curriculum from the outcome-based curriculum to competency-based curriculum, and also change of system from the current 844 to the new 2663 system of education. But in all these changes that we have been implementing, they have always faced financing gaps. And what financing gaps inevitably do is to lead to policy implementation gaps, which then lead us to failure of realizing the objectives of those interventions. Next slide, please. So we are here to look at how do we finance the transition to CBC and make sure that this time there are no gaps in financing and that we are successful in achieving the objectives of the transition from 844 to CBC. Several things, three things actually need to be of prime importance to us as we think about this transition. One, we need clear agency. We need fidelity to the plan that we set out to implement, and we need focus on the overall goal. And the overall goal is that this country faces education injustice for most children in the country. That a lot of children in this country either don't get to school or go to school to grow up, and they don't benefit from being in school at all. So we are focusing on these three things if we need to be able to achieve the dream that CBC promises the children of this country and therefore promises the future generations of this country. For these three things to be in place, we need to do certain things. And for me, if you ask me now whether they're in place, they are not, in my opinion. And not being in place means something and means a challenge to the mission that we have embarked on, which is transiting from 844 to CBC. What are the implications of not having clear agency, not focusing on the main goal? The consequences are that, one, we have funding that is scattered and not optimized. And what do I mean by this? We have money that does not have a clear coordinator of how it is utilized. So we have put money in building classrooms without a clear framework on where do we build the classrooms. And all of us recall that last year the government put 4 billion shillings. Those classrooms were built in secondary schools. Now children are transiting to primary schools. And the whole question of how do we now get laboratories in those schools is being raised now, because there was allocation of resources that were not coordinated, and therefore no value was actually generated from that allocation. Because of the fact that there is no clear agency again, funding is either delayed and sometimes not even disbursed because of squabbles over the mandate. For instance, for the last few years, Teacher Service Commission has been allocated resources to train teachers. Service. TSC does not have training mandate, does not have training of education. Private sector actors who are playing a role in the implementation of optimize the utilization of the resources available. So sometimes we have had that arise from unclear mandates on whose responsibility a particular activity is. Number three, we have activities that are uncoordinated, sometimes poorly sequenced and also poorly executed. Why do I say this? Last year, the government made a decision that we are going to hire 30,000 teachers to support the transition to junior secondary. While the decision was made last year, the process of recruiting teachers has only begun now, with 2 weeks to the start of the new school year and the new school term, when we expect that these teachers would have been recruited, trained, and deployed in schools ready to take up their assignments. So we are implementing the activities poorly. We are not sequencing them properly because of lack of an overall coordination mechanism. And in the end, we are causing more confusion among actors rather than drawing synergies from the various actors' activities to ensure smooth transition. Number four, we have activities that are often delinked from the overarching goal. And what is our overarching goal? Our overarching goal is to promote education justice, to enable every child in this country to access and benefit from quality education so that they can be able to reach their full potential. That is the promise in SDG 4. That is the promise that Kenya has committed to in ratifying all the protocols on the rights to education for every child. But when we look at the activities that are being undertaken, when we look at the fact that minimum threshold of being schools, which actually educate 65% of the children going through secondary schools in this country. And we are allocating resources to the national schools, well endowed, but educating only 3% of the children in the country. Those are activities and funding plans that are detached, delinked from the overarching goal of promising every child an equitable chance to access quality education. We also see unsatisfactory and sometimes delayed outputs coming out of these haphazard, uncoordinated processes that we are implementing in this transition process. And one of the things that can be a clear indicator of this again is the fact, for instance, that now we are hiring teachers 2 weeks to children reporting to schools. In the junior secondary school, we have 12 learning areas. One of those learning areas is life skills. If you check in our teacher training colleges, you will not find a single teacher training college that had among its courses something called life skills. So that means that we are hiring teachers who do not have content on life skills, and we want to take them a 3-day training. They will get into school without capacity to teach some of these learning areas that have been created for junior school. We are also hiring primary school teachers who do not have capacity to teach integrated science. We actually even don't have secondary school teachers with capacity to teach integrated science, which is also one of the learning areas. So we expect that we will get unsatisfactory output from this activity we are engaging in because of haphazard planning, because of delayed action, and because of lack of accountability mechanisms among the various actors in the sector in terms of who will take responsibility for the failure in the end. Because of all this, we have ultimate failure on the horizon at the end of this transition process. And for us, ultimate failure means that you have transited, yes, you have taken children away from 844 to 2663, but at the end of the cycle, when they get out of university, the overarching goal that we sought to address, which is to promote education justice, has not been met. And that is the challenge that we need to respond to this year as we draw the budget. Next slide, please. So what are our priority recommendations for this year? We are making recommendations that, one, we restructure the funding within the ministry. And I mentioned in the beginning that we are not asking for more money to be sent to the Ministry of Education because it is already receiving the lion's share of our budget. We just want that money to be restructured to fund the following three key things. One, to fund the establishment and operationalization of the National Education Board. This board is provided for in the Basic Education Act of 2013. But if for some reason the Ministry of Education has never wanted to establish it, it is supposed to advise the minister on, or the cabinet secretary, on all matters to do with basic education in the country. We expect that this board will have the mandate to oversee the smooth implementation of CBC and therefore to oversee the transition process. It will have the mandate to coordinate all the sagas within the Ministry of Education and liaise with the National Treasury to make sure that allocation of resources is based on the proper sequencing of the activities that need to be implemented, and that the actors are coordinated to act in sync to ensure there is seamless transition and seamless implementation of CBC going forward. So that is one thing that we want to see funded. It has not been funded for many years. It has